Many people talk about ETFs as if they're one specific investment, but there's a lot more nuance than most people realize. And if you don't understand the key differences, it can be very easy to pick the wrong one. So here are 10 things that you need to know. ETFs can have very similar names, but differ greatly in terms of exposure. A key one here being the difference between all-world ETFs and world ETFs. That's because MSCI have an index called the MSCI World Index, but in fact it actually only covers developed countries. Compare that to FTSE's version called the FTSE All-World Index, which covers both developed and emerging markets. MSCI do have a fund that covers the whole world, but it's called the All-Country World Index, abbreviated ACWI. The other thing that's easy to assume when looking at global funds is that they're evenly spread across the world, when in reality, most are very US heavy, around 60% exposure. This is more a reflection of how big the US stock market is on the world stage and how it's performed in recent years. So you need to decide what level of exposure you're comfortable with, because it is subjective that a global fund is totally diversified with that level of US exposure. When you invest into an ETF, you'll have a choice about how you want the income to be treated. If you invested into an equity ETF, for example, many of those underlying companies will choose to pay out a dividend as a reward to shareholders. The ETF will then pull those payments together and then pay them out, usually on a quarterly basis, but it can differ. But if you decide that you don't need that income, you can choose to have this reinvested automatically for you. The fund does this on your behalf, and then you'll see this return in the share price rather than paid out as income. If you do decide you want that income to be paid out, one of your key considerations will be what the dividend yield is. That's the dividend payment as a proportion of the share price. But dividend yield only tells a fraction of the story, and high yield doesn't automatically mean high quality. There's two main reasons why a company might want to pay out a dividend. First is to reward existing shareholders and to keep them invested, but also to incentivize new investors coming in. But it's important for the financial health of the company that it can sustain those dividends. Some companies will even go into debt to pay out a dividend because rewarding those shareholders or attracting new ones is so important to them. But if they can't sustain it, that tells you a lot more about the actual financial health of that company. So when you're analyzing the quality of a dividend for a company, you not only need to look at the yield, but also the ability for that company to grow that dividend and look at what it's done in the past, but also things like its dividend payout ratio. So that's the proportion of its profits that is paid out in a dividend. And if it's paying out more in dividends than it's earning in profits, then it's clearly not sustainable. One of the biggest mistakes I see people make with ETFs is treating them like individual holdings. We're taught in investing that we need to be diversified, and that automatically makes us think that we need to have multiple holdings. We're not content with just owning one or two ETFs. But what usually ends up happening by owning too many ETFs is that we have overlap in our investments. And actually, ironically, in a bid to be diversified, when we overlap too much, we end up being overexposed to certain areas. And actually, we're not that diversified. A common one is where people choose to hold both the S&P 500 and a global ETF. And as we touched on earlier, a global ETF has around 60% exposure to the US. So if you had a 50-50 split in each of those two ETFs, instead of 60% exposure, if you had an S&P 500, your exposure now to the US would go up to about 80%, which is extremely high for one country. And some people even take this a step further by including the tech-heavy NASDAQ index because it's performed so well recently. But also forgetting that the S&P 500, when you look at its top 10 holdings, the majority of those companies are big US tech companies. But we can also see this in other areas as well. For example, if you want to invest into a European ETF, if you already own the FTSE 100, you've got to be really clear whether you want a European fund that includes the whole of Europe or whether you want one that excludes the UK. So if you did invest into a European fund that included the UK, some of your exposure would be duplicated because you already own the FTSE 100. And that might be intentional, but you need to be really clear about what your goals are here. When people talk about the best ETFs, it's very subjective because what does best mean? Does best mean having the best past performance? And if so, over what time frame? Does it mean being the most diversified? Is it the lowest cost or the highest yield? And it means what's best for one person doesn't always mean it's best for you, because what you choose has to fit alongside your other investments, and it has to be suitable for your risk tolerance and your time frame. For example, energy stocks have performed really well over recent years and have been very popular. But if you're getting close to retirement, do you really want that level of volatility in your portfolio? Likewise, if you're in your early 20s, money market funds have been really stable. But if you've got a really long time horizon, do you want to be sitting in a low volatile investment when you can ride out volatility? So although we always want to rank things and we always want to see a clear order about what the best investment is, it's always going to be subjective. And the most important thing is that it's suitable for your personal situation. The terms ETFs and index funds tend to get used interchangeably, but you could see ETFs as just the vehicle that a fund uses. And while many ETFs do simply track an index, they're increasingly being used by active fund managers. There's no right or wrong choice here. You just need to be aware that if you do go down the active route, you're essentially betting on that fund manager outperforming its comparative benchmark or index. And very few have proven to do this over a long period of time, and you will pay a little bit more for this as well. Some areas do seem to get better results for active fund managers, so it's not to say that all are bad, but you just need to go into it knowing exactly what you're paying for. If you want more help with anything that we're discussing in this video, or you just want a place to discuss it, I do have a community where we have over 100 members, and you can find out more using the top link down below. Just because a fund holds multiple assets doesn't automatically make it diversified. A lot of people invest into the S&P 500 because they believe it's a well-diversified fund. And that may well have been the case more so in the past, but today the top 10 now makes up a weighting of around 40% of the fund. Hardly what you'd call diversified. And you can also get specific region and sector ETFs. And while these aren't necessarily bad, they need to be seen as complementing other investments rather than single holds. Your level of diversification will always be subjective. And like we've already touched on, some people swear by the global approach, but even that isn't perfect. Using Vanguard's global ETF as an example, it's weighted 60% towards the US, and although it invests into over 3,600 companies, 10 of those make up a quarter of the entire fund. And it also has a 27% weighting to technology stocks. So this goes back to the point about what best actually means. Are we going after potential returns, or do we want just to be the most diversified? That's a choice you have to make yourself. The rise in popularity of ETFs and free-to-use platforms has meant the competition between ETF providers has never been higher. And when it comes to fees, this is a massive area of competition because just a difference of 0.1% on an annual fee can make a massive difference to your overall returns. But what we've also got to consider here is more of a hidden cost, and that's the spread, the difference between the buy and the sell price. And generally, as a rough rule of thumb, the bigger the fund, the smaller the spread because there's generally going to be more liquidity. And so you could pick a fund that looks cheaper on paper, it could have a cheaper TER, but if it's a smaller fund, every time you go to buy and sell that fund, you could be paying more of a spread. And actually over a long period of time, that really does add up. In a bid to stand out, some providers create specialty ETFs where they utilize some form of financial engineering as a selling point. For most investors, these usually should be avoided, but I'll quickly touch on them. Buffer ETFs aim to limit downside by using put options, usually a specific percentage of the losses, but it also caps upside. Covered call ETFs use call options to generate extra income, but it also caps upside. Leveraged ETFs look to amplify gains by using borrowed money to invest, but of course this also increases downside risk, and it's also reset every day. Hedged ETFs look to reduce currency risk, which can be useful for shorter term holdings, but generally over the long run, these risks tend to average out. If you're investing into an ETF that tracks an index, the name of that fund matters much less than the index itself. If you understand the index, you understand what you're actually buying. And that's because ETFs can have very similar goals while tracking different indices. So it's important not only to compare the ETF itself, but also the underlying index. And a key one with this is looking at how index providers classify specific countries. For example, FTSE classify South Korea as a developed market, whereas MSCI still classify it as an emerging market. So if you're looking to track an emerging markets index, you'll get very different results depending on whether you're looking at FTSE or MSCI. And of course, vice versa, if you're looking at a developed markets index. Once you've decided what you're going to invest into, you almost need to forget what's happening in the markets right now. If you're investing into an equity ETF, ideally you want at least a 5-year time horizon. And if you don't have that, then you have to accept that you're going to take on more risk. A lot of people try to time the market because they want some form of discount, which is just a natural instinct. But the problem with waiting for a dip is that it might not come for a long period of time. The market could go up another 20% before it comes. So once you've decided that investment, don't overthink it much past that, especially if you're investing regularly. Make it automatic. Set up that direct debit so you don't have to think about it. So as soon as you get paid, it's going into your investments. And even if it does come down, because you're averaging into that investment, it's not the end of the world. And the other thing with this is that you stick to it and you make it sustainable, which is why it's important that you make it realistic. So don't be too ambitious with that monthly direct debit to start with. You can always increase it later down the line. A lot of this is about building that habit. And you get used to the fact that every time you get paid, You have a certain amount that goes into your investments. But if you have to turn that off because you've been too ambitious, that breaks that habit and you fall into this trap of just sporadically investing. And that will actually more likely make you want to try and time the market because now you have more choice. But actually, when you remove that choice and make it automatic, most likely you'll also remove that emotion. And that's when you'll most likely make better decisions. I tried to keep this quite quick fire, but let me know if there's anything else you would have included down below in the comments. Thanks for watching, and I'll catch you in the next one.